In 1998, a fund called Long-Term Capital Management almost broke the system. The traders were not fools. They were brilliant. They had models, PhDs, and years of profitable history. Then Russia defaulted, spreads blew out, liquidity vanished, and positions that were supposed to offset each other started losing together. That is the moment I want you to picture. You are right on the edge of being forced out, not because your idea was crazy, but because the world moved into a regime you did not price in. What do you do when you cannot know what happens next? Decision-making under uncertainty is not about being right. It is about staying solvent long enough for your edge to show up. Uncertainty means you do not know the true odds. Risk means the odds may be known or estimated, but the outcome still varies. In markets, we often pretend we are dealing with risk when we are really dealing with uncertainty. That confusion is where most blow-ups live. A normal adult understands uncertainty already. You feel it when you buy a house, change jobs, or decide to have a child. You cannot run the future in a lab. Markets just compress that feeling into prices that move every second. The danger is that the screen gives you the illusion of precision. A price is precise. The future is not. I think about expected value a lot. Expected value means the average outcome over many repeats. If I could replay the same decision 1,000 times, what would I earn on average? The problem is that in real life, you do not get 1,000 repeats with the same conditions. You get one path with changing rules and your emotions riding shotgun. Still, expected value is useful because it forces a question. Am I taking a bet where the upside compensates for the downside, given what I can reasonably know? Then I add variance. Variance means how spread out outcomes can be. Two strategies can have the same expected value, but one can have a much wider range of outcomes. That wider range is not just uncomfortable. It can be fatal if it creates a drawdown you cannot survive. A drawdown is the drop from your peak to your trough. Drawdowns matter because they change your behavior. They also change your ability to keep playing. This is where leverage turns from a tool into a trap. Leverage means using borrowed money or derivatives to control more exposure than your cash would allow. Leverage magnifies both gains and losses, but more importantly, it magnifies the speed of loss. Speed is what kills you. LTCM had positions that looked diversified on paper. Diversification means not having all your eggs in one basket. But in a crisis, correlations spike. Correlation means how often assets move together. In calm markets, correlation looks low. In stress, it can jump toward 1, which means everything moves together. That is a regime shift. A regime shift means the market changes its behavior in a way your recent data did not capture. I want you to notice the psychological hook there. Humans learn from recent experience. That is recency bias, the tendency to overweight what just happened. If the last 5 years were calm, you start to believe calm is normal. If the last year was a bull market, you start to believe dips always bounce. This is not stupidity. It is how brains work. The risk manager response is not to shame the bias. It is to build a process that assumes you will feel it. Warren Buffett is often described as patient and rational. What I take from him is not a magic stock list. It is his respect for uncertainty. He talks about a margin of safety. Margin of safety means you buy with enough cushion that you can be wrong about some inputs and still do fine. That is decision-making under uncertainty in one phrase. It is not about forecasting perfectly. It's about structuring the decision so forecast error does not ruin you. Charlie Munger pushed the same idea from another angle. He emphasized base rates. Base rates are the historical frequencies of outcomes in similar situations. If I am looking at a hot company with a perfect story, the base rate question is simple. How often do companies priced for perfection actually deliver perfection? In the dot-com bubble, many businesses were real, but the prices assumed a future with no competition and no recessions. The uncertainty was not acknowledged. It was priced as if it did not exist. When the future arrived, it was normal, and the prices were the thing that was abnormal. Traders face a different version of the same problem. Jesse Livermore is a classic example of someone who understood tape reading and crowd behavior, but still struggled with the human side of uncertainty. In trading, you can have a positive expected value and still lose many times in a row. That is not a flaw, it is variance. If you size too big, variance turns into ruin. Risk of ruin means the probability you hit a loss so large you cannot recover. Most people think their biggest enemy is being wrong. In practice, the biggest enemy is being wrong at the wrong size. That brings me to position sizing. Position sizing means how much you bet on each idea. It sounds boring. It is not. It is the difference between a bad month and a career-ending event. A simple way to think about it is this. If I am wrong, how much do I lose? And can I keep making decisions after that loss? If the answer is no, the position is too big, even if the idea is great. Some people hear that and say, fine, I will just diversify. Diversification helps, but it has limits. In 2008, a lot of portfolios that looked diversified were really one trade. They were long growth, long housing, long liquidity, long the assumption that refinancing would always be available. Liquidity risk is the risk that you cannot exit at a fair price when you need to. In 2008, liquidity disappeared in places people thought were safe. Forced sellers set the price. If you are levered, you do not get to wait for value to be recognized. You get margin called. A margin call means your lender demands more collateral now, not later. That is how good long-term ideas die in the short term. Now I want to talk about controls and incentives, because uncertainty is not just market volatility. It is also human systems failing. Barings Bank collapsed because of Nick Leeson, a trader who hid losses and doubled down. The story is not only about one person. It is about broken controls. Segregation of duties matters. That means the person who trades should not be the same person settles and reports the trades. If one person can both take risk and mark the score, uncertainty becomes unbounded. Incentives matter too. If upside is rewarded and downside is hidden or delayed, you get tail risk. Tail risk means rare extreme losses that sit in the tails of the distribution. They feel invisible until they arrive. Then they dominate everything. This is why I teach people to respect convexity. Convexity means your payoff changes in a curved way, not a straight line. A simple example is buying an option. Your downside is limited to the premium. Your upside can be large. Selling options is the opposite. You collect small, steady gains. Then you face a large loss when the rare event hits. Many blow-ups are hidden short option positions, even when no options are involved. If you are short volatility, meaning you benefit when nothing happens, you are quietly betting against uncertainty itself. George Soros talked about reflexivity. Reflexivity means prices can change fundamentals and fundamentals can change prices in a feedback loop. That matters because uncertainty is not passive. Your actions and the market's actions interact. A bank that looks healthy can become unhealthy if funding dries up. A company that looks strong can become weak if its stock collapses and it cannot refinance. In reflexive systems, the future is not just unknown, it is partially created by the path you take to get there. So how do I make decisions when I cannot know? I keep coming back to process over prediction. Prediction is tempting because it feels clean. Process is messy because it admits error. A good process asks what needs to be true, what can go wrong, and what happens if I am late. It also asks what I might be missing because everyone agrees. Consensus is comfortable. It can also be a trap. When everyone is on the same side, the market becomes fragile. Fragile means it can break easily from a small shock because positioning is one-sided and exits are crowded. I also respect time. Time is a risk factor. The longer you hold, the more things can happen, but the shorter you hold, the more noise you must endure. Noise is random price movement that does not reflect fundamentals. Many people confuse noise for information. They overtrade. They pay spreads and fees. They burn attention. Attention is a limited resource. When attention is depleted, decision quality drops, and uncertainty feels larger than it is. Paul Tudor Jones is known for thinking about defense first. I do not mean being timid. I mean knowing that the first job is to stay in the game. Stanley Druckenmiller is known for pressing when the odds are strong, but he also cut risk when conditions changed. That is adaptability. Adaptability means you update your position when new information arrives without clinging to the original story. The hard part is knowing what is information and what is noise. There is no perfect rule. That is the point. Uncertainty cannot be eliminated. It can only be managed. One practical way I think about it is this. I separate what I believe from what I can prove. Belief is a narrative. Proof is price action, balance sheets, cash flows, credit conditions, and positioning. Even proof has error bars. An error bar is the range where the true value might lie. If my decision only works when my estimate is perfectly correct, it is not a robust decision. Robust means it still works when reality is a bit worse than expected. I also watch my own behavior for signals. If I feel the urge to check the price every minute, my size is probably too big. If I feel angry at the market, I am treating uncertainty as unfairness, which is a mental mistake. The market is not fair or unfair. It is a distribution of outcomes. My job is to choose exposures where the distribution is acceptable. In the end, decision-making under uncertainty is a craft. It is part math, part psychology, part humility. You use probabilities, but you do not worship them.